Welcome to Real Estate Beast, your guide to mastering the art of real estate investing. I'm your host, Michel Kmiotek, and today we're delving into a fundamental aspect of real estate investment that separates the amateurs from the experts: illiquidity. So join me as we explore the depths of this concept, uncover its challenges, and unveil strategies for navigating it like a seasoned investor. Let's kick off our exploration by demystifying the notion of illiquidity and understanding its profound impact on real estate investments. Illiquidity, simply put, refers to the lack of readily tradable assets. Unlike stocks or bonds, which can be bought or sold with ease on the public markets, real estate transactions often require a significant amount of time and effort to complete. This inherent characteristic of real estate investments shapes the dynamics of the market, influencing basically everything from investment strategies to risk management practices. Several factors contribute to the illiquidity of real estate investments, and each are playing a critical role in shaping market conditions and investment outcomes. The type of property is a significant determinant of liquidity, with certain property types exhibiting higher levels of liquidity than others. For instance, residential properties tend to be more liquid than commercial or industrial properties due to the larger pool of individual buyers in the residential market. Market conditions also exert a significant influence on property liquidity. During periods of economic downturn or low demand, selling a property can become a daunting task, leading to extended holding periods and diminishing liquidity. Moreover, the location of a property plays a crucial role in its liquidity, with properties situated in prime locations often commanding higher liquidity due to the increased demand from buyers. The illiquidity of real estate investments presents a myriad of challenges for investors, testing basically things like their patience, resilience, but also strategic acumen. Firstly, the protracted timeline associated with selling a property can tie up capital, limiting investors' agility and the ability to capitalize on emerging opportunities. If your cash, for instance, is locked up in one property, you cannot move on. This extended time to sell can prove particularly problematic during times of economic uncertainty or shifting market conditions, amplifying basically the risk of capital erosion and opportunity cost. Secondly, the limited pool of potential buyers for real estate assets can exacerbate illiquidity, constraining market liquidity and hindering transaction velocity. Unlike stocks, which boast a global market and virtually unlimited liquidity, real estate markets are localized, characterized by a finite demand and supply dynamics. So this inherent limitation can prolong the selling process. It can increase also the transaction costs and exacerbate price volatility. Prices can go up fairly quickly, they can plummet fairly rapidly as well, whereas the stock market is a market which all players can have all the information at all time, supposedly. Real estate, on the other hand, is not the same. Let me paint a picture for you. Imagine a sprawling 5,000 square meter commercial property nestled in the heart of a city, boasting a rich history that dates back to the 1950s. For decades, this property was a bustling hub of activity. It attracted shoppers, tenants, and businesses alike. However, as the years passed, the landscape of retail and commercial real estate began to shift. So fast forward to the present day, and this once vibrant property finds itself struggling to stay afloat. Shoppers flocked to newer, better located shopping centers, leaving the aging property behind. It's just not that cool anymore. With foot traffic dwindling and vacancy rates rising, you will probably have issues finding new tenants. There's large companies are hesitant perhaps to rent this space because it's just an outdated building. This further exacerbates its decline. Now let's delve into why selling this commercial property has become such a daunting task. Firstly, the buyer pool is extremely limited. Given the property's size, age, and declining appeal, only institutional investors or top-tier developers with deep pockets would consider purchasing it. These are basically the players who have the financial resources and expertise to take on a project of this magnitude. Secondly, even for these selected buyers, the hurdles are still significant. Rezoning the area to allow for instance, residential development, such as condos and apartments, would be essential to unlock the property's true potential. However, convincing the local government to approve such rezoning can be extremely lengthy and it can be a difficult process, something that not all buyers want to take on. In the face of these challenges, how can savvy investors navigate the treacherous waters of illiquidity and emerge victorious? Now, one strategy is, as always, patience. Recognizing that selling a property of this nature is not a quick fix solution, but rather a long-term endeavor. And it is essential to know that the way you got in will determine the way you got out. Investors must be willing to play the long game, understanding that unlocking the property's value may take years of strategic planning and negotiation. Another strategy is creativity. Thinking outside the box and exploring alternative uses for the property, such as mixed-use developments or adaptive reuse projects, can also open up new possibilities for value creation. By reimagining the property's potential and capitalizing on emerging trends in urban development, investors can breathe new life into even the most obsolete properties. Good examples of these are, for instance, old warehouses that are being repurposed in a different way, where we can put in shops, restaurants, and on the top parts we put in residential units. And another good example are, for instance, using pop-up stores in order to use an older building, an older commercial property, and just revitalizing every now and again by putting a short-term tenant into it. Alright, now picture this, a cozy one-bedroom apartment nestled in a bustling urban neighborhood, offering convenience, affordability, and charm. In contrast to larger commercial properties, small apartments like this one have the potential to attract a larger pool of buyers due to their lower barrier to entry and broad appeal. One of the key advantages of investing in and later on selling a small apartment is the larger buyer pool it attracts. With lower price points and greater affordability, small apartments appeal to a wide range of potential buyers, from first-time homeowners to investors looking to diversify their portfolios. This broader appeal translates into increased demand and a faster sale, as multiple interested parties will flock to the opportunity to secure the property. However, with greater demand comes increased competition. In a market flooded with similar but not identical apartments, sellers must contend with the challenge of standing out from the crowd. From staging and marketing to pricing and negotiating, sellers must deploy strategic tactics to basically differentiate their property and capture the attention of discerning buyers. This, my friends, of course becomes more and more difficult when the market shifts and there's more and more of similar priced and similarly looking apartments on the market. So in the face of stiff competition, how can sellers navigate the maze of selling a small apartment and emerge victorious? One strategy is effective marketing, leveraging digital platforms, social media, and professional photography can help showcase the unique features and benefits of the property, and this might and should attract qualified buyers and drive up interest. Another strategy, of course, is pricing. Setting a competitive price that reflects the value of the property while remaining attractive to potential buyers is essential. Sellers must carefully analyze market trends, comparable sales, and local demand dynamics to determine the optimal pricing strategy. It's a strategy, my friends. It's not just, hey, what is the price of my property? That's not something that an agent or real estate professional can answer. There has to be a strategy behind the pricing. And this is what maximizes the returns and accelerates the sales process. Contrary to popular belief, real estate investing isn't solely reserved for those with deep pockets or aspirations of grandeur. In fact, the reality is quite the opposite. While large-scale developments and commercial properties may garner headlines and attention, the heart of real estate investing lies in the everyday opportunities that surround us. For most investors, the path to success begins with a shift in mindset. Rather than fixating on the allure of massive properties and multi-million euro deals, investors must embrace the reality of their own circumstances and resources. This means recognizing that success in real estate investing is not about the size of the investment, but rather the quality of the opportunity and the alignment with your own investment goals. So where do these opportunities lie? The answer is all around us. From modest residential properties to small-scale commercial ventures, there's opportunities all around us. Whether it's a fixer-upper in a burgeoning neighborhood or a turnkey rental property in a stable market, the key is to keep an open mind and remain vigilant for opportunities that basically always do align with your investment strategy and goals. There's no point of buying a fixer-upper if you're the type of investor that only goes for turnkey apartments. There's nothing wrong with those. Equally important is the recognition that investment success is not measured solely by the size of the investment, but also by the investment horizon. For some investors, short-term flips and quick profits may be the name of the game. For others, it's all about long-term buy and hold strategies that may offer the most promising path to wealth accumulation. The key is to align your investment horizon with your financial objectives and risk tolerance, and to remain disciplined and patient in the pursuit of your goals. Here's a real-life personal example. Several years ago, I found myself exploring various investment opportunities, searching for a market that offered both potential and growth. After extensive research, I stumbled upon the Romanian real estate market, a hidden gem, in my opinion, that offered compelling advantages for savvy investors like myself. Today, I'm not that sure about it anymore, but let's get into the reasons why I went into it at that point. First off, affordability. One of the primary reasons I chose to invest in Romanian real estate was its affordability. Compared to the other European markets, property prices in Romania were significantly lower, allowing me to acquire high-quality properties at a fraction of the cost. This affordability not only reduced my initial investment outlay, but also increased the potential for attractive returns in the long run. Let's get into those attractive returns. Another compelling factor that drew me to this market was the yield. Rental yields reached as high as 8% in the first year and are basically right now climbing to up to 15% just after 3 years. So the ROI offered by Romanian properties were far exceeding those available in many other markets. And this strong and consistent cash flow provided a solid foundation for building wealth and achieving financial independence. And the third reason was that they were turnkey investments. What truly set Romanian real estate apart for me was the abundance of just basically getting a turnkey investment opportunity available on the market in a great location. So these properties were fully renovated, sometimes there were tenants, and managed by a good management company. So it required minimal time and effort on my end. This hands-off approach allowed me to enjoy the benefits of the real estate investing without the hassle of day-to-day management. Now let's get into reason number 4, No need for bank loans. So lastly, one of the most attractive features of investing in Romanian real estate was the fact that I didn't need a bank loan to purchase properties. I didn't have to go to lengthy applications to get a loan approved in order to purchase a property. The prices were so low that I could basically buy it all cash. Unlike any other markets where financing can be a major barrier to entry, real estate in Romania offered opportunities for me as a cash buyer to acquire properties outright, eliminating the need for costly and time-consuming loan applications. And I just didn't have to worry about the loan payments. I just put in my cash and get rental returns. In conclusion, my journey of investing in Romanian real estate has been both rewarding and fulfilling. Not always easy, but capitalizing on the affordability, attractive returns, turnkey nature, and accessibility to the market, I've been able to build a diversified portfolio of properties that generate consistent cash flow and long-term appreciation. They are basically located in good locations, so I'm not worried about finding tenants at any point of their vacancy. If you're considering real estate investing, I encourage you to explore the opportunities available in Romanian real estate. It may just be the perfect investment destination for you. That's why I always say keep an open mind and cross borders if you can. To sum it all up, despite the formidable challenges posed by illiquidity, savvy real estate investors employ a diverse array of strategies to navigate and capitalize on this fundamental characteristic of the asset class. Diversification emerges as a cornerstone strategy, allowing investors to spread their risk across different types of properties and geographic locations. So, by diversifying a real estate portfolio, you as an investor can mitigate risk, enhance liquidity, and optimize risk-adjusted returns. Taking a long-term perspective is another key strategy for managing illiquidity effectively. So, by adopting a patient and disciplined approach to real estate investing, investors can weather short-term market fluctuations and capitalize on long-term wealth-building potential for real estate assets. So, this commitment to long-term value creation enables you to harness the power of compounding growth and capitalize on emerging trends and opportunities in the real estate market. In conclusion, mastering the intricacies of illiquidity is essential for success in the world of real estate investing. By understanding the factors contributing to illiquidity, investors can deploy robust strategies to mitigate risk, because that's what it's all about in the end. You don't want to end up with a property that you cannot find any tenants for, nor buyers. So enhance that liquidity, my friends, and optimize returns. Whether you're a seasoned investor or just starting out, remember that illiquidity is a fundamental characteristic of real estate investing that should be embraced and managed strategically. Alright, that wraps up today's episode of Real Estate Beasts. Thank you for joining me as we delved into the complexities of navigating illiquidity in real estate investing. Remember to tune in next time for more invaluable insights and strategies to help you thrive in the dynamic world of real estate investing. Until then, happy investing.